Podcast is now starting. All attendees are in listen-only mode.
Good morning or good afternoon, and welcome to our webinar, Developing and Articulating Your Bank's Risk Appetite Statements, and KRIs. My name is Jeff Rigsby, and I'm the President and CEO of CB Resource, and I will be presenting today's session. First, I do want to thank you all for taking time out of your busy schedule to join us today. In our invitation, we said the session will run about 30 minutes, and we're certainly committed to keeping to that schedule. Now, before we get started, just a couple of quick housekeeping items and ways to get the most out of the webinar. You certainly can ask questions in real time if you like. There is an instant messaging capability built into GoToWebinar, and by all means, you can take advantage of that. We will have time available at the end also for some Q&A. And I also want to mention that should you like a copy of the presentation materials that we'll be using today, by all means, send us a request via GoToWebinar, send us an email, feel free to give us a call. And this session will also be recorded to the extent anyone would like to have a recorded copy. All right, so let's go ahead and get started. We are going to provide a brief overview of how to develop and articulate your bank's risk appetite, develop those risk appetite statements, and then zero in on developing some quantitative key risk indicators, key performance indicators. We're going to try to cover quite a bit during this session, so I hope you don't mind if I move through the process with a little bit of pace. Bear in mind, if anybody has any follow-up questions post session, by all means, feel free to reach out to us. Here's what we'll be covering in today's session. So first, we'll start with the definition, right? What is risk appetite, and what does that framework look like and consist of? Then we'll talk briefly about where risk appetite fits in an enterprise risk management process. Then we'll dive specifically into the 4 steps to develop your risk appetite, your framework, your statements, and your KRIs. And we'll kind of bring it all together at the end of that and then share some closing thoughts. So let's start with the definition. What is risk appetite? So risk appetite is the level of risk your bank is prepared to accept to achieve its financial and strategic goals and objectives. Your risk appetite should set a clear strategic direction and should establish thresholds or tolerances in pursuit of earnings, adequate capital, and shareholder value. Said another way, when you think about it, your risk appetite really defines what you're willing to do or not do in pursuit of making money and creating value, right? And if you think about this framework, the framework we'll be sharing with you today, and we'll get into this a little more further into the session. But at first is, what are the categories we're looking to establish, right? So in this case, this example, you can see we're looking at 8 key risk categories, and we're using risk categories as the framework, right? So credit risk, interest rate risk, etc. And then we're looking at a 5-point scale. So is our risk appetite low, low, moderate, 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 high, or high? So kind of a 5-point scale. So as we go through the process, we'll try to help you quantify that to some extent, but bear in mind there's a certain amount of art that comes with this process as well as science. Now, when you look at this, so this is just a flow chart of a typical top-down ERM process. And by the way, I want to mention, for those of you that either have an ERM system or you're evaluating ERM systems, one of the clear non-negotiables of a good ERM system is making sure you can clearly define how it identifies risk, how it measures risk, how it monitors risk, and how it controls risk. And you can see those are kind of the further pillars in this process. But for the purposes of defining where risk appetite fits, your risk appetite is kind of the tip of the spear of your ERM process. The level of risk you intend to take basically sets the conditions or requirements that help you determine the scope or the overall context of your ERM program. If you think about an ERM as a process or a program, it's not a one-size-fits-all. The model is the model. But when you think about your risk appetite, start thinking about the conditions within that risk appetite that set the tone for your process, right? So let's suggest, or let's just say you have an above average appetite for growth, or you're offering a certain complex product set, or you're going after certain target customers, or you're involved in an aggressive M&A strategy, or you're really looking to leverage technology to serve customers and become more efficient. All those elements set a tone of what a level of risk you're willing to take. And the more you understand the level of risk you're willing to take, the more you can ensure you calibrate your ERM system to align itself with that level of risk, right? So if you've got a modest growth appetite and your product set hasn't really changed much, your customers haven't really changed much, but you just want to improve your control systems, that's great. But hey, if you're an SBA bank and you're running 600 to 800% CRE concentrations, you're growing like a weed, all those other factors, you're going to want to make sure that your ERM system behind that risk appetite discussion provides the adequate level of analysis to identify, measure, and monitor and control that risk. So just kind of want to put this in context up front that there is a method to the madness. We tend to be champions of a top-down approach, and that's what this really reflects. It says, hey, our strategic plan sets the tone of what our risk appetite is, and we control risk aligned with those intents. So now let's take a look at our process. So before you get started, it is important, and I want to emphasize, to put together some sort of simple project plan to ensure you get the job done when you want it done. So in this case, your goal is to develop your risk appetite framework, right? That heat map. You want to develop risk appetite statements, and then you want to select a series of key risk indicators to key performance indicators to help you monitor and determine how you're performing within the scope of your risk appetite. So this checklist does nothing more than to ensure that you're considering the right factors to get the job done, right? So first of all, forming a team. Typically, risk appetite can be the senior executive team and the board. Many banks we work with kind of bring the board in afterwards, and they may even expand the board's role in subsequent years. But first of all, the team typically is a senior group of leaders. This isn't a risk assessment process. This is strategic. So these are the smart people that are setting the guidance and the direction of where you want to take your bank over time. So your team members would be typically the executive team, and to some of you, you might even want to involve your audit committee or the whole board as part of the process. Once you've got your team set, you want to establish a schedule, right? So you're going to do some analysis. You're going to evaluate a lot of data. You're going to populate that heat map. You're going to be drafting these statements, and you're ultimately going to be selecting or nominating KRIs and setting parameters of those KRIs and KPIs. So be thoughtful in terms of how much time it's going to take. And maybe you're going to do it over a period of 30 days with 3 meetings, or one big old meeting over 2 days. But whatever the process is, set that target. The third thing is make sure you've got the information necessary to develop an informed framework. Right? You need your strategic plan. You need your capital plan. Shortly, I'm going to show you a grid of proposed items that we believe should be part of the consideration process when you're establishing your risk appetite framework and statements and so forth. Once you've got those things in order, now you're ready to get the process going. And at the end game here, you should have a well-documented product, if you will, that articulates the 3 things we've been talking about, and it should be ready for board approval. So just, make sure you've got a process. If you don't, these things tend to get into what I would call project creep. So what are the 4 steps that at least the 4 steps we use to develop your risk appetite? So here they are. And we'll take the balance of our time together here to do a deeper dive into each one of these steps and go from there. So step number 1, we talk about understanding your strategic value drivers. And that really is all about your risk appetite, where you want to go, how you want to get there. And if your strategy is getting more than your fair share, be it market share, be it loan growth, deposit growth, whatever those key factors are, you really have to get your head around your key strategic drivers as the initial part of this process. And I'll talk a little bit more about that as we go into the deeper dive in each of these steps. Second step, the framework, right? Looking at that grid, establishing what framework you're going to use, and we're going to get into that in a minute, and determining, so what are your risk categories? And we use a 5-point scale. You may have some other different choice you may want to use. but come up with the scaling and come up with the parameters of what moves you from low to high. And in that step 2, right, it's populating that heat map or creating levels within that heat map. Step 3 is to develop the risk appetite statements. Risk appetite statements are nothing more than an expanded definition of what you mean in that heat map. So if you say your credit risk appetite is moderate, then your risk appetite statement should help you define that. Some banks like to go with overall broad risk-based or risk appetite statements that are kind of all-inclusive, and we certainly do that with clients that want to do that. I will tell you, we have a bias, and we think that if we're talking about credit risk or interest rate risk or liquidity risk, or if you're an OCC bank and you got price risk, strategic risk, operational risk, compliance, those of that nature. Then if you have subs like wealth or wealth management, trust, each one of those areas actually should be defined on their own. So that's just a personal opinion, but that's how we roll. And then lastly, step 4 is developing those key performance indicators or key risk indicators. You've gone through all this trouble of saying this is what we're willing to do or not do to make money and create value. You've defined them. How do you measure and monitor it? And that's what step 4 is all about. So let's talk about step 1, your strategic value driver. So your strategic goals or your value drivers are kind of central to determine what your level of risk is that you're willing to take, right? And if you think about it, your strategic plan, whether implicitly or explicitly, if you've done a risk appetite framework, by all means, it should be in your strategic plan. They coexist, right? Your heat map or your risk appetite should be nothing more than indicate what you're willing to do or not do according to your strategic plan. Your strategic plan tends to have a 3 to 5 year outlook. And so you're kind of setting the tone of what you're going to do in terms of driving things like market share or ROA and ROE, capital levels, how efficient you want to be, the level of and quality of your assets, how you're driving deposits, other factors that lead to your competitive edge. But you need to kind of have your mind around that as you get ready to populate that heat map, because that is going to be the basis of forming what level of risk you're willing to accept or adopt in each of the key risk categories, right? And bear in mind, risk appetite is kind of fluid. So you establish it with your strategy, but on the other hand, as time goes on and environments change, the economy changes, competitive landscape changes, management team changes, whatever those factors are, your risk appetite statement is dynamic, right? It may change over time. But when all's said and done, just always remember it comes back to what you're willing to do or not do to make money and create value. And again, those strategic drivers are really going to set the tone. Now, when we look at step 2, which is really about establishing your framework and considering, what do you consider to populate the framework and alignment? So we've broken it down into 3 subcategories for step 2. So the first thing you want to do is come up with what framework you want to use. Some people like CAMELS as a framework, right? It's not uncommon. You certainly get a CAMELS rating, so CAMELS is certainly an acceptable framework to establish your heat map or your risk appetite framework. You also have regulators that have their own view, right? If you're an OCC bank, OCC gives you their risk profile in every annual assessment, right? And they've got 8 categories. They've got credit risk, interest rate risk, liquidity risk, price, operational risk, compliance, strategic, and reputation. Hey, if you want to go with your framework to match your regulator's framework, you could do sillier things, right? That could make sense. Same with Fed member banks, credit, market, liquidity, operational, legal, reputational. We kind of work with a hybrid that seems to go over well, right? So we lead with major key risk categories like you see in this heat map, credit risk, interest rate risk, and so on down through cyber risk. But then if you have trust services, you can add trust. If you have insurance, add insurance. If you do wealth management, add wealth management. If you have other wholly owned subs that you feel are part of your business model, then add those categories. But we find this framework translates well at every level, be it at the board, at the management team, or certainly if the regulators are your audience. So this first step really is all about adopting a framework that makes sense for you. And so that's kind of the first step of building your framework. The second one, and this is where it gets a little complex, it's like, so what types of questions do I have to ask to determine what level of risk I'm willing to take? And let's use credit. Credit's kind of easy, and probably for most of you, credit represents 50 to 60% of the overall risk you're taking at your bank, maybe even more. But if you think of factors that will determine if your risk appetite and credit is low to high, well, first of all, ask yourself, how much do you intend to grow? Are you going to grow at a modest level or kind of break-even level? Or maybe it's going to be above average growth. Maybe it's going to be quantum growth. Maybe you have acquisition in mind. Those growth factors determine where you start moving through that continuum, right, from low to high. So you've got growth as a key factor. Then ask yourself, what types of loans am I making? And what's my portfolio look like? Hey, I've got a lot of banks I work with that have a pretty robust factoring business. So if you're in factoring, what does that do to your risk appetite? You're an SBA bank and you're running high CRE concentrations, be it in construction and land development or non-owner or owner-occupied CRE. Those indicate the level of risk. I want to mention something. A lot of times we get really good at something. And let's say that you are an SBA shop, or let's say you're an ag bank and you do dairy and poultry, and let's say you do a ton of it. You've got a high dependency on it, and you're really good at it, and you're under the impression you're not really taking any risk because you're good at it. Remember, just because you're particularly good at something doesn't mean you're not taking risk. If you're doing an abundance of something, if you're taking certain steps towards maximizing yields or optimizing performance, there's inherent risk with that. So just think about it as you go through each of these categories. So credit, whether it's growth, asset quality, yields, customer types, market types, M&A, organic growth, those factors all drive your risk appetite rating, right, or level. And you can apply these same disciplines. As you can see in this grid, we've set up little prompts so that you could kind of use it like a checklist. Going into operational risk, think of it everything from your use of third-party vendors to your leverage of technology, serving your customers, creating efficiencies, managing your business, the level of ACH and wire transfers you do and the size that you do, how many branches you have. Again, if you're into M&A, these are all factors that create a composite level of risk you're willing to take. And it kind of goes on. So I'll suffice it to say these are the factors you need to consider. If you'd like a copy of this grid just as a prompt, we'd be happy to share it with you. You just shoot us a note. And so then the third step in step 2 is populate the heat map, right? You've asked all these questions. You've selected your category. So systematically go step by step through each one of the key risk categories. Ask yourself, what are we willing to do or not do here? And if we've got an above average growth, if we've got a certain level of complexity in the markets we serve, in the product selection we offer, in the customers we serve, those things will all influence where you end up mapping the level of risk you're willing to accept, right? So you've selected your framework, you've gone through your considerations. Now you're just assigning values low to high, right, within each one of these. And by all means, you can sit on the fence. Looking at this image of operational risk, they just couldn't quite determine if it's moderate or moderate high, So you can do a little fence sitting as well. You can also take assessments that give you quantitative scores. Just bear in mind, the important thing when you're developing your risk appetite is you have to focus on the collaboration and team agreement, right? Because everyone might look at risk a little differently. The purpose of developing risk appetite statements and having an ERM system is to get a level of agreement across the key decision makers of the organization. So that kind of gets you to your heat map. So now we've got our heat map. So step 3 is all about defining each one of your risk ratings and what they mean, right? So it's funny, Steve Jobs has this great quote, and he said, the art of effective leadership is to take the complex and make it simple. So I hope you keep that in the back of your mind as you work to develop your risk appetite statements. I don't have full appetite risk statements to share with you here. I'm going to give you some guidance as to what we do. We try to do 2 things and so we're suggesting you do 2 things. Number 1, so when you say your risk is X, so if we say credit risk is moderate high, okay, great. So tell me what that means. So why is it moderate high? So the first thing your statement should do is define it, right? So why is it moderate high? Number one. Number two, we think it's good business to add 2 or 3 sentences regarding how you control that risk. So if you have a certain level of risk appetite you're willing to take, then take a little bit of time, add some sentences about your processes and your controls and your systems and your people and your capabilities that allow you to set this risk at whatever level you're setting it at. But just to give you some quick examples here, we've got a credit risk one, pretty straightforward. Hey, our credit risk is moderate to high. So this individual said, hey, our bank is a 4. Our credit risk appetite is moderate high. We recognize that our concentrations in CRE, our SBA business, our growth rate, and our consistent entry into new markets are the primary contributing factors. It's a definition, right? And whatever your definition is, that's where you put it as to what drew you to the conclusion of your risk rating. From there, then just take a little time and talk about how it is you control that risk. Looking at operational risk, this is an example of saying, hey, moderate, high. Okay, our operational risk appetite is moderate to moderate high. When considering our desire to adopt technology solutions that enhance our client experience and improve efficiencies, we also are exposed to an increased level of risk associated with ACH and wire volume and size, and the growing dependency on third-party providers. So those aggregate items led to this bank determining it's right in between moderate, high. Now, if all of a sudden you've got a fintech partner and you're going great guns into a national platform, you might be high. If you're into mergers and acquisitions and you have to integrate, people and products and systems, operational risk, that could be high. Okay, just keep that in mind. Lastly, strategic risk, moderate. Our strategic risk appetite is moderate, reflecting our intent to achieve above average growth and earnings. Our goal is to consistently achieve balanced growth, deposits, and loans while seeking opportunities that provide material and sustainable increased earnings. So that kind of statement saying we don't rest on our laurels, right? We're looking for growth. So just bear in mind that these statements can be qualitative, but when you get into your KRIs, it's where you get quantitative, right? You start establishing the framework. So you've developed your statements. Then lastly, it's that KRIs. These are the quantitative measures. So if you think about this as the last step in the 4-step process, this is what allows you to kind of monitor the level of risk you're taking versus what you say your risk appetite is, right? And so the metrics can either, they could be key performance indicators, key risk indicators. To be honest with you, we call everything key risk indicators, but key risk indicators tend to be external. Key performance indicators tend to be internal. You're going to use both, right? And so if you think about it, what you're looking at on this grid is nothing more than coming up with your key risk category. You can actually put your risk appetite falls in this range and come up with some of them. So if it's credit, you could be looking at growth rates, asset quality, exceptions, CRE concentrations. We kind of talked through those. And then you establish a low to high range that you can track over time. Same thing with interest rate risk, liquidity, operational risk samples. You might get into more qualitative stuff, right? You might even actually have your CAMELS composite rating in there. But you could have things like, credit and debit card fraud incidents, IT exams, bank sec network, penetration testing. But it's really about driving to those vital few that can help you keep a monitor on this. And then, guys, the gold standard is once you've established your KRIs, you start asking yourself, how does this help me look forward, right? Can I use my KRIs or my KPIs to help me also start identifying emerging risk or threats and gaps that might exist in those areas? So, at the end of the day, documenting your risk appetite, we believe, is fundamental to an effective implementation process of good strategy and certainly supports an ERM process. So the images you see on the screen should be something like the outputs you come up with, right? So you should be able to have a heat map that says, hey, here's what my risk appetite is by key risk category, or however you define that framework, and discuss it. That next image is saying, so, hey, by the way, here's my risk appetite statements. This is what I mean when I say my risk appetite is X. And then come up with something visual, right? Something that first create a scorecard to figure out what those KPIs and KRIs are, but then come up with some visual reporting, right? That says, hey, it's worth tracking over time. Benchmark it, run variances, Take a look at, are you running? Because again, this is a tool. It's operationalizing your pursuit of optimizing business performance. And that's just kind of an insight from our perspective. So with that, and kind of in summary, just follow the 4 steps, right? Don't, start with what your strategy says. Start with your strategic plan. Where are we going? How are we going to get there? Once you have those drivers clearly in mind, select your framework, right? Come up with what you want to use. And when I say framework, I'm really talking about the areas, right? Whether you're using key risk categories, camels, or something to be determined later. But what does that framework look like? Something that makes sense to you, your board, and ultimately to other, viewers, be it regulators or whomever. But get that framework selected, populate that framework, then describe what you mean in the form of risk appetite statements, and then spend the balance of your time. I will tell you that KPIs and KRIs will not be done in a day. It's a work in progress, and sometimes just allow yourself the luxury of taking a year or so to figure out what works and what doesn't. You want to go to vital few that give you good indications of how your risk really is sizing up against your appetite. Okay. So I do have a little bit of a closing thought with you, because there's things out there called a risk profile and there's things called a risk appetite. And sometimes we get them confused. I'll be working with banks on their risk appetite, and they're thinking about they're measuring their risk, right? And that's a risk profile, guys. When you're doing a risk assessment and you're asking yourself, what's the inherent risk? How well do we control that risk, which would be like adequacy of risk management? What's the composite or residual, and what's the direction? That's a risk assessment. And that could be an enterprise risk assessment against the same risk categories. That's a profile. That is your actual risk view, if you will. Your risk appetite is more of a desired state, right? That's your rule book. That's your rules of engagement. So if you think about the two, if you have a risk appetite, and I know this grid doesn't have one, but let's say you've got an area like credit or operational risk that says we have a high risk appetite somewhere. Then if you come over here to your risk appetite or your actual risk profile, and the inherent risk might be high, which you would expect, inherently the risk is high. But let's say you're high there and your adequacy of risk management is acceptable. Well, you might want to say, is that acceptable if we have a high appetite there? Does that score need to be strong, acceptable? Does it need to be strong? So there is a relationship between risk appetite and risk profile. One is your rule book, your desired state. The other is the actual state. And use it as kind of like a gap analysis tool, if you will. So I just want to kind of leave you with that thought as we wrap up our time. Before we go to questions and answers, you got to let me say, we think we have a great ERM solution. It's modular based. It ensures that you have a proven and effective process to identify, measure, monitor, and control your risk. We specialize in synchronizing risk management and performance indicators. That's kind of our hook. And our board reporting and management reporting mechanisms tend to give us an edge against the competition. The fact that we're modular also gives you some service alternatives or delivery. We have a full ERM solution, but we also bite-size ERM. And so if you want to just do risk appetite, if you just want to do an enterprise risk assessment, work on policy and governance, or do top risk analysis and mitigation, those are broken down into standalone service deliverables. So with that, I know we're kind of butting up against our time. We've had a little question in the corner. I think this came up when I flashed the risk profile up, but let's see if I can interpret this. You spoke of the difference between risk profile versus risk appetite. Is there a similar model, or how do you get? Let's see. How do you come up with the bank's risk profile? I'm assuming most of you do risk assessments. So either with a service provider like somebody like us, or perhaps you've built your own tools internally, or you've worked with your audit group. But your risk profile, all I'll say about that is if you can mirror your risk appetite, it's useful, right? So if you're using these risk categories to say this is the level of risk we're willing to take or not take, then it's awfully useful for your risk profile to line up with your risk appetite. And what that is doing nothing more than going through a series of questions by risk category. So if you're looking at credit risk again, what are the questions you can ask that determine what your inherent risk is? And that gets into things like credit quality and ALLL levels and growth rates and portfolio mix and CRE concentrations and asset quality. But assess those things from an inherent risk standpoint, measure your controls. Those two items should create a composite score, which would be your residual risk, and then determine where you think it's going. But the source of a risk profile tends to be a series of risk assessments that answer the question of what's my inherent risk, what's my adequacy of risk management, or my control effectiveness. And I put those two together, what's the leftover risk or the composite risk, and then where is that risk going? So probably a simple statement, overly simplified, but that's that. And then let's see, I've got one other one here. If I can open it up. Oh, here we go. What do you consider? Oh, the difference between risk appetite and risk tolerance. Great question. Risk tolerance to me is more granular. And that would be what I would call advanced risk appetite 102, 103. But risk appetite establishes the level of risk you're willing to take almost at a strategic level, right? Big risk tolerances starts getting into the more granular levels. And I would argue that your risk tolerance can be determined within your KRIs, if that makes sense. So risk tolerance gets into the specifics of we'll do this to that, where your overall risk appetite framework is kind of more strategic, more top down. Tolerances get into measurable levels at a granular level. I hope that answers your question. Okay. Well, I've run a minute over. I do want to thank all of you for, again, taking time out of your busy schedule. If you would like a copy of this presentation or a copy of the recording, please just let us know via the GoToWebinar or through an email or give us a call. I've also, on our contact information, you'll also see Robert Finch is our Director of Sales and Marketing. And Robert would love to hear from you, and his contact information is in this presentation as well. Thank you for your time. I hope we have the opportunity to work with you in some form or fashion, and you have a great day. And for those of you on the West Coast, stay dry. Take care.